Hello and welcome to our digital discussion with James Rickards on the new Great Depression. Jim Rickards is a good friend of mine, and he has been already a guest of my digital talk. But this time we are going to present his new book. And before we are doing this, I would like to introduce Jim very shortly. So he is the editor of the Strategic Intelligence, which is a financial newsletter, and he's also director of the James Rickards Project, an inquiry into the complex dynamics of geopolitics and global capital. He's also the author of Wall Street Journal and national bestseller Aftermath, which we also presented in Vienna. This is my copy, by the way. And the three New York Times bestsellers, The Road to Ruin, The Death of Money, and Currency Wars. But also the national bestseller, The New Case for Gold. All from the Penguin Random House, which is also publishing the new book. He is an investment advisor, lawyer, and economist, and has held senior positions at Citibanks and other organizations, institutions. Among the many activities, he has been also a contributor to various prominent media outlets, such as the Financial Times, the Telegraph, the New York Times, Washington Post, and so on and so forth. Now, the reason why we are here today is because we want to discuss his latest book, which is The New Great Depression, Winners and Losers in the Post-Pandemic Time. This book, which I have had the pleasure to read, is particularly interesting because we are still actually within the pandemic, and it is still not clear how long actually it will last and what will be the repercussions for the economic and the social systems, not only in the West, but also in the developing world. Now, Jim, I would like to start with actually with the first, not the first, but the second chapter of your book, because the first chapter deals, in fact, with the chronology of the events from 2020 when the virus outbreak began. So I would like to move to the second chapter, which is actually focused on your assessment about the cost of the lockdowns, but also, so to say, the cost of the pandemic for our economic systems here in the West. Particularly, you are, of course, focusing on America, but I would also appreciate if you have some words for, your estimation, basically, for the European recovery. So the floor is yours.
Well, thank you, Velina. Thanks for the introduction, and thank you for mentioning the book, The New Great Depression. By the way, I know we have a global audience. We're live streaming, and you have a global following. But I also know your center, your think tank, is in Vienna, and just would mention for readers there that the book is available in German. The German language edition came out. Actually, the German language edition came out a day before the English language edition. Often it takes 6 months or a year to do these translations. The other books have been in 14 or 16 different languages, but a lot of the foreign rights publishers, foreign language publishers, got the manuscript early and did the translations right away. So our publisher in German is FBV, Finanzbuch Verlag. My German is not very good, but that's how I understand it. But it's also a bestseller in the German language edition for the audience there. But yeah, to get back to your question, it recalls a conversation I had with my editor when this whole book came up. They first talked about it in last April. I got a call from my agent. They said we absolutely need a book on the economic consequences of the pandemic, and we'd like you to write it. And we worked that out and went forward on a very fast track. Sometimes a book can take, as you know, a year or 2 years or more to write, but we said this has to be done in a matter of months get it out to the audience. We were able to do that. But my editor said, Jim, we love your work on economics and capital markets and growth, inflation, all that, but keep away from the medicine, the medical side of it, because you're not a doctor. And I said, no, that's impossible. That's like asking someone to write a book about property damage in New Orleans in 2005 and not mention Hurricane Katrina. You have to get to the cause in order to understand the consequences. So they agreed. And I was very wary of the fact that I'm not a doctor. I mean, I'm not really intimidated by natural science. I think it is accessible, and I read over 100 peer-reviewed papers from major journals, The Lancet and New England Journal of Medicine and others to get up to speed. But you can definitely follow it. I don't have to look under an electron microscope to understand what's going on. But the way we constructed the book, and you're exactly right. So chapter 1 was about the virus, the outbreak, the source of it, how it spread, how it was handled, etc. Chapter 3 jumps into the economics. That's the new Great Depression. Chapter 4 is about policy responses and so on. But chapter 2 that you mentioned is the bridge. That's the one that goes from the medicine to the economics. And it's about the lockdown. And just to kind of summarize, there's a lot of evidence to support this. Lockdowns don't work. They do not work to stop the spread of the virus. They are very good at destroying economies. And that's what we've done. By pursuing lockdown policies, we've destroyed certain national economies and severely damaged the global economy without any benefit in terms of the spread of the virus. Now, that sounds controversial, but actually the evidence is there to support it. When I wrote that last spring, and I did update the book as late as October, so the book came out in January. It's very very fresh, very up to date in that sense. But I started doing a lot of this work last May and June, and the evidence was pretty clear then that lockdowns don't work. But since then, as late as even today, I mean, just new reports coming out on a daily basis, the evidence is overwhelming that lockdowns don't work. There's a story out today that this extreme lockdowns in the UK have stopped the virus in Sweden. That sounds funny, but the author's point is that lockdowns have nothing to do with the spread of the virus. So let me give some concrete examples to back that point up. So in the United States, there are 50 states, of course, and we never had a national lockdown in the United States. It went state by state. It was up to each governor or each mayor to set up a lockdown policy. And they did. And some of them were extreme. So New York and California had extreme lockdowns. Some states like Florida had a moderate lockdown. And then there were states like South Dakota that had no lockdown. They never did. The governor made it completely voluntary. She said, let's have education, wash your hands, social distance and all that. But I'm going to leave it to individuals and entrepreneurs to decide if you want to go to a restaurant or not, or you want to close your restaurant or not. So there was never a lockdown in South Dakota. The same thing around the world. Spain, Italy, Germany, and other countries had extreme forms of lockdown. Sweden had a moderate lockdown. And Brazil, at least at the initial stages, had no lockdown at all. So we have those results from 30 countries around the world and 50 states in the United States. And what they show, and this is very, very good empirical studies, what they show is there is no correlation between the kind of lockdown policy you pursued and the spread of the virus. Or put differently, there's no evidence that a lockdown has any material effect on the spread of the virus, none. And I did an interview the other day with an Australian audience, so South Asian, Australia, New Zealand, and one of the questions that came in is, it was from someone in New Zealand. They said, we had an extreme lockdown and the spread of the virus has diminished greatly. Don't you think there's a lesson there for the United States? And I said, no. I said, I know you had an extreme lockdown and I know that virus has diminished, but I could point to many examples where they did not have an extreme lockdown and the virus has greatly diminished also, which means there's no correlation, which means that lockdowns don't work. So that evidence is overwhelming. But it begs the question, why do politicians continue to impose lockdowns? Well, the answer is it's political. Politicians can't be seen to do nothing. Sometimes doing nothing, by the way, is the right policy. Not always, but sometimes that's something you should think about. But politicians have to do something. They don't know the science. They don't understand what we're discussing now. They throw on these lockdowns. Sure enough, the virus does diminish, and they say, see, it's a success. And the answer is no. You would have got the same result anyway. And meanwhile, you've destroyed your economy, small businesses, entrepreneurs, et cetera, jobs, growth. We'll come back to that. So the best predictor of the spread of the virus actually was from an Israeli mathematician, an applied mathematician, statistical scientist, who published a paper, and that it was available last spring. It's in my book. By the way, Velina, in the book, I hope everyone reads the book and gets a lot out of it. But if you just had the notes, that by itself is extremely valuable, because I put all those sources. There are 200 endnotes in the book, and if for anything I say, if you want to go to a primary source, look at the study, that's available. But what this Israeli mathematician showed, he was very candid. He said, I'm not an epidemiologist, I'm not a virologist, but I have all the data. And he showed that when there's an outbreak, and it can be geographically separate in time, it can be chronologically separate, it can be a different variant. So you have to kind of define outbreaks, but they do pop up here and there. New ones were coming along all the time. And he showed that it runs its course in about 8 to 10 weeks. If you see an outbreak and a steep increase in caseload and a steep increase in fatalities, you can be pretty confident that that's going to get worse for about 4 or 5 weeks, and then it's going to tail off, and then it's going to be over in about 8 to 10 weeks. Doesn't mean there won't be another outbreak somewhere. Doesn't mean that there can't be a mutation. You've got to be very alert to that. But what it does mean is that you can actually predict these things. And if you look at the United States, and this is true globally, by the way, I should make that clear, but if you look at the United States, our first wave was kind of March and April of 2020. It was circulating in February, but it really took off very steeply in March and April, peaked, and then came down by around June. And that's when everyone said, we can reopen the economy and get back to normal, Penup Demand, and all that stuff, which I said at the time was nonsense, but it turned out to be correct. But then there was a second wave that started in August, September, peaked around late September, and then tailed off by October, greater than the first wave. Then the new cases became very low. The caseload increase became very low. And then there was a third wave, which started in around mid-November, and then peaked in January, and now has tailed off very steeply. But if you look at that third wave, at the peak, which was around January 8th, the caseload was 9 times greater than what was happening in March and April. We all remember March and April 2020. We were all, staying home and quarantined and locked down. No one was going out. The economy was, falling precipitously. But the caseload increase in late December, early January was 9 times greater. The fatalities were double. By the way, the difference in factors between caseload and fatalities had to do with treatments. The treatments are better now than they were then, but the virus goes where it wants to go. And now that it's tailed off, which is good news. But all 3 of those waves ran 8 to 10 weeks. So it seems to me that this Israeli mathematician got it right. Certainly the evidence bears him out. And if you see another outbreak, don't panic. Don't, shut down your economy, but you should suppose that it's going to last 8 to 10 weeks, because that's been a pretty consistent pattern around the world. However, when do lockdowns get imposed? Well, when the caseload is at its peak in the curve, so after about 4 weeks, the politicians panic, they lock everything down, and then sure enough, the virus starts to diminish after that. But the point is, it has nothing to do with the lockdowns themselves. So that's my bridge over to the new Great Depression. And again, you say something like that, it's not very, I'll say politically correct. It's not very popular, but the evidence is there. There are numerous studies in the 50 United States, in 30 countries around the world, beginning last spring, continuing until, new studies are coming out all the time that show that lockdowns don't work. But they do destroy economies. Now here, there's another important aspect. So people say, well, wait a second, Jim, the stock market, U.S. stock markets are at an all-time high, and they are. They crashed about a little over 30% between late February and late March. Then they came back, and then they reached new highs in September, and now they're at new all-time highs. So they say, see, the economy's great, everything's back to normal. And I say, no, the stock market has never been more detached from the real economy. Here's the stock market up here. Here's the real economy down here. Why is that? Well, the main index, people talk about, in the United States, we talk about the Dow Jones index, but in fact, institutional investors, professional money managers, analysts look at the S&P 500, the S&P 500 stock index, and that is at or near all-time highs. But what many people don't understand is that that is what's called a cap-weighted index, meaning as a company, your influence on the index is based on your market capitalization, and the bigger your market capitalization, the bigger impact you have on the index. And in fact, the S&P 500 should really be called the S&P 7, because there are 7 companies, and we know who they are. It's Apple, Amazon, Facebook, Google, Netflix, Microsoft.
Big tech, so to say, right?
Right. Those 7 companies are 40% of the market capitalization of the entire S&P 500. So what that means is that whatever those companies do, that's what the index does. Well, the companies I just mentioned, those 7 companies, are the least affected by the pandemic. Nobody shut down Amazon. Nobody shut down Apple. There are digital companies, electronic companies, technology companies, streaming companies. In other words, they're companies that don't have any significant amount of bricks and mortar presence or et cetera. And now we're in a feedback loop, a recursive function where, so the index goes up. So what do Americans invest in? And people around the world, actually. Well, they don't buy individual stocks anymore. They buy an index fund. So they put money in the index fund. The manager buys the index, which means buying the 7 companies I mentioned. It goes up. More money comes in, it goes up more. More money comes in, it goes up more. So we have a very strong bubble dynamic. So 2 things are going on. The S&P 500 is the S&P 7. Those 7 companies are almost unaffected by the pandemic. In fact, some of them have benefited enormously, starting with Amazon. And then people keep putting money into them because we have this recursive function going on. So it really looks like a bubble. I wouldn't short the index right now. I mean, it'd be like standing in a highway in front of an 18-wheeler truck going, 100 kilometers per hour and saying, stop, there's a cliff ahead. You're just going to get run over, So I wouldn't do that. But I think it is important for investors to understand that dynamic. Meanwhile, what's going on in the real economy? Well, using the United States as an example. So last spring, they shut down basically small business, restaurants, bars, salons, dry cleaners, shopping boutiques, et cetera, all these small businesses. And 2 things happen. One, they say, well, it'll come back in the summer, the summer 2020, which it didn't, but that was the thought at the time. And we'll have what they call pent-up demand. When I heard the phrase pent-up demand, I thought, well, it sounds like green shoots in 2009. Remember, green shoots, never happened. We had a 10-year recovery with the weakest growth of any recovery in U.S. history, 2.2% average annual growth for 10 years. So we never quite got out of that one in terms of return to the potential growth curve or the normal growth curve. You could call that a depression. But just to give an example of pent-up demand as they described it. So during the quarantine of, March and April 2020, let's say I didn't go out to dinner for 9 weeks, because I didn't. I usually go out to dinner on a Friday night with my wife or whatever, so we didn't. But by the summer, July, some restaurants started to reopen, so we went out to dinner. But when I went out, I didn't order 9 dinners. I ordered 1, like I usually do. In other words, there was no pent-up demand for the 9 dinners I skipped. That was a permanent loss, and many of those jobs are permanently lost. And a lot of those, I said restaurants reopened. Some of them reopened. Most of them didn't. They shut down permanently. They walked away from their leases, put up their equipment at fire sale prices. Terminated employees are permanently unemployed. They were not hired back. And walk up and down the streets of any small town or major city, for that matter, in the United States. I'm sure it's true around the world. You'll see every 3rd or 4th shop is empty, with a for lease sale, for lease sign in the window. So those are permanent losses. So, but some people say, well, who cares? It's a restaurant. They only have 20 employees, wait staff and bartenders and so forth. Well, first of all, I care, and the unemployed people care, and the owners care. But when people look down their nose at small business, what they don't understand is that, the individual businesses may be small, but in the aggregate, small and medium-sized enterprises are 50%, 50, of all jobs in the U.S. economy, and 45% of GDP. And the same is true elsewhere around the world. In any developed economy, service economy, that ratio is about the same. It doesn't matter if it's Spain or Italy or Austria, those percentages are about the same. So when you shut down half your economy, even if you say, 50% capacity, I mean, New York's a joke. They said restaurants could open at 25% capacity. Well, anyone who came up with that order, it was Governor Cuomo, doesn't understand the restaurant business. They work on 10% margins. So how are you supposed to make money if you have a 10% margin and you're at 25% capacity? You can't even cover your fixed costs. So you're going to go out of business, and they are going out of business. These businesses, they don't have $5 million of working capital. They make money, they pay their bills, they pay their employees, and they make a small profit, but they don't have the kind of money you need to shut your doors and remain in business. So they just go out of business, and half of them have. So here's the stock market for the reasons I mentioned. It's way up here, and then here's the stock market. Here's the real economy. There's this gap between the perception and the reality. Reality always wins. In the long run, reality will win. That gap will shut. The stock market will come back down, but it won't necessarily happen right away. So the short answer is, lockdowns do not work to stop the spread of the virus. They do work to destroy economies. We're doing a very good job of creating permanent job losses, permanent terminations of businesses, and we'll struggle to get back to any kind of normal growth.
Mm-hmm. Yeah, I think you're connect. I'm not hearing you right now. Oh, okay, perfect.
Can you hear me now?
Yes.
Okay, good.
Now, this was really important clarification when it comes to the lockdowns, because we are still very much in the. I suppose that 2021 won't be much different than 2020 when it comes to further lockdowns. And of course, if we look at China, it will tell another story, because they have the very successful, according to the media coverage, story of the Wuhan lockdown of 69 days altogether,
right.
Which we then saw in a documentary, showing us all the tourists, a million of tourists flooding the city to see where the whole thing started. And I think they had 15 million tourists just over a week in October. But basically, of course, it also was a part of a propaganda showing that China has successfully tackled the pandemic. But still, what is important, I think, for the discussion is to move to the more important question, and that is the question about what comes next. And
right.
As you point out, even in your title, there will be losers and winners in the post-pandemic world. Now, I would like to focus on my next question on the chapter considering the New Depression, so that you can also explain for our listeners and watchers, so viewers, what exactly do you mean by New Depression? I also would like to stress that we had already a similar conversation last year, before the lockdowns began, before the virus outbreak was really has been unleashed, so to say, in Europe and America. And we were discussing the recession cycle, we were discussing the global trade slowdown, and also the case of a global power competition between the United States and China under Trump's administration. Meanwhile, we have a new US president and the same Chinese president. And I think that these issues are still very much on the table. But on the other side, we are going probably to witness a new kind of policy coming out from Washington when it comes to dealing with Beijing. So how does all of this come together? Who is going to be the winner, and who is going to be the loser, or are going to be the losers of in the post-pandemic world, and how is it connected to the question about the global economic recovery, if there is such?
Sure. Well, that's a fantastic question. It's a lot to unpack because there's a lot of parts there. But let me sort of take that one by one. First thing, just a footnote on your last comment. I know what the story coming out of China is, but the Chinese lie about everything. So I put almost no weight on what they say happened. For example, I've been to Wuhan, not recently, but I've been there some years ago. I was all over the city. I kind of have a sense of it. It's a huge city, a little bit of a tech center for China. Along the Yangtze River. They were scooping up dead bodies on the streets. They were putting people in crematoria who were still alive. They were barricading people inside their homes that literally couldn't get out. They were prisoners, putting like steel beams in front of doors, and they lied about the statistics. So I would say yes, China has contained the virus as of now, but the losses, the infections, the deaths were far greater than they've admitted. The tactics were far more inhumane than they've admitted, and I don't think they have any success that they can share with the world, unless you think, putting people in a crematorium when they're still alive is a good idea. That's kind of the Chinese method for doing it, not to mention the lack of privacy, the surveillance state, and doing a lot of things that would just be considered inhumane, even crimes against humanity in any other country in the world. So I don't give China any. They have contained the virus. That's a fact, but I don't give them any credit for the methodology or the accuracy or any information coming out of China. Not to mention the fact that the evidence is very good, and I talked about this in my book, that the virus did leak from the Wuhan Institute of Virology. It did come from a laboratory. This whole wet market theory is nonsense. It's part of a cover-up that's been conducted with the World Health Organization. The one U.S. delegate to the World Health Organization that went in there recently to do a so-called independent investigation is completely financed by Chinese research grants. He's about as independent as Xi Jinping. So I don't put any weight on that. Don't give it any credibility. Okay, so let's flip over to policy responses, which are in two main forms all over the world: monetary policy and fiscal policy. And in the United States, I mean, the numbers are publicly available. The Federal Reserve, or central bank, if you use M1 money supply, I always find it curious that they have four definitions of money. It makes you wonder what money is, but they have M0, M1, M2, M3, etc. But using M1, which is a popular, kind of widely accepted, common sense view of money, they have printed $3 trillion in the past year. So M1 money supply went from approximately 3.9 trillion to 6.9 trillion in the past year. I have to get used to saying trillion. I used to say billions, but now we have to use the P word. So they printed $3 trillion of new money. On the fiscal side, it's important to bear in mind that the United States was projecting $1 trillion deficits before the pandemic. For fiscal 2020 and fiscal 2021, they were saying we're going to have $1 trillion deficit before any stimulus, so-called stimulus, or before the pandemic. So that's your baseline. Then in the spring of 2020, Congress enacted $2 trillion of so-called COVID relief. Then in December 2020, right at the very end of the Trump administration, they passed almost another $1 trillion of spending, deficit spending. It was about $950 billion to be precise, but call it $1 trillion. Right now, the Biden administration is just a few weeks away from passing another $2 trillion deficit spending bill. That will probably become law. It's on a fast track, and the Democrats control Congress, so that'll become law by probably the end of March. But they've already announced, and I'll give the Biden administration credit for transparency, they tell you what they're going to do. They've already announced an additional $4 trillion deficit spending bill for later this year, probably by September or so. So just add that up. So that's $6 trillion under Biden, $3 trillion under Trump, that's $9 trillion, plus $2 trillion of baseline deficits. That's $11 trillion of deficit spending in 2 fiscal years under both administrations combined, Trump and Biden. The U.S. national debt before the pandemic was about $23 trillion. So we've increased the debt by almost 50%. It took 230 years to get to 23 trillion, and it took 2 years to get to 34 trillion, with an $11 trillion of deficit spending piled on top of that. Now they keep calling it stimulus. 3 trillion in money printing is stimulus, and $11 trillion of deficit spending is stimulus. It's not stimulus. It's not stimulating. It is printing. It is printing money, yes, and it is deficit spending, yes. They're very good at both of those things, but none of this is self-sustaining. And let me give you again a concrete example. At the end of December, everybody in America, not everybody, but most people got $600 checks. This was this is from the Trump bill, the $950 billion that they did at the end of December. So everybody got a $600 check. And most of them got them kind of late December, early January. Well, we just got retail sales for January, and they were up significantly. Well, what a surprise. You give everybody a $600 check, they go out and spend it on stuff, and retail sales went up on a month-over-month basis. That's not surprising, but the question is it sustainable? Have you created sustainable growth? Have you done something that will feed on itself in a positive way, or did you just hand out money and people spend it? It's clearly the latter, and it begs the question, okay, everyone got their $600, a lot of people spent it. What are you going to do next month and the month after? Are you going to keep doing multi-trillion-dollar spending bills? Are you going to keep handing out checks to kind of prop up the economy? Well, so far the answer appears to be yes, they are. Because Trump wanted $2,000 checks, he got 600. But the Biden administration is going to have the other 1,400. You're going to get your $1,400 check probably in late March or early April. I don't doubt that some portion of that will be spent. It'll give the economy a little boost. But my question is this sustainable? Have you created sustaining growth? Does it feed back on itself? Have you saved all those small businesses that are shut down? Have you created jobs for all the people who are permanently laid off? Have you increased the labor force participation? It hasn't done any of those things so far, going back to last spring. It's just as I say, a temporary boost, and you're spending money and you're creating a bigger deficit. Now, here are the problems. And again, let me be specific. The research is very good. This comes from Carmen Reinhart, who's now the chief economist at the World Bank, and Kenneth Rogoff, who's a professor at Harvard, but others as well. Not just in the Reinhart-Rogoff book, but in a series of papers published by the National Bureau of Economic Research. It shows that when debt to GDP ratios go above 90%, the Keynesian multiplier drops below 1. Now, what does that mean, just kind of in plain language? Well, if your debt to GDP, so just take the national debt, divide it by GDP, and that's your debt to GDP ratio. If that ratio is at 30%, let's say, which last time the United States was there was 1980, that's very sustainable. You can borrow more, you can get some benefit from it. You're in good shape in a fiscal sense. When the debt to GDP ratio gets to 60%, you're in a little bit of a danger zone. And this is what Angela Merkel has always banged the table about. And this is in the Maastricht Treaty for members of the European Monetary Zone. They have to stay below 60%. But what Reinhart and Rogoff show is that at 90%, you go through the looking glass. And you now, so below 90%, if you borrow $1 and spend $1, you'll get more than $1 of GDP. You might get $1.20 or $1.15. There are diminishing marginal returns. You might get to $1.05, but you borrow $1, you spend $1, you get more than $1 of GDP. When you go past 90%, you get less than $1 of GDP. You borrow $1 and spend $1, and you get maybe 90 cents of GDP or 80 cents of GDP. In other words, it's not only diminishing marginal returns, which is typical of any complex system, but you're not even getting your dollar back. So now what's happening? So here's the debt, here's the GDP, so it's a fraction. Now you borrow $1, spend $1, the debt goes up by $1, but GDP only goes up 90 cents. What's happening to the ratio? It's getting bigger. It's going from 90% to 100%. So where's the United States? Well, when Trump took office in 2016, 2017, that ratio is 106%. Today, it's over 130%. So who else is in that club? Who's in the 130% club? Well, in the entire, sorry?
Japan, right? Japan?
Uh, Japan, yeah, yes. Japan is in a world of its own. I think they're kind of free riding on the U.S. But the only other countries at that ratio are Greece, Lebanon, and one other. Italy, right? Greece, Lebanon, Italy. So there's your lunch table. That's your club, the super debtors club. And yes, Japan is kind of in a world of its own. But Japan's now entering their fourth decade of depression. You know, the Nikkei index hit 40,000 on December 31st, 1989. Today, it's somewhere in the high 20s. They've gone 30 years, over 30 years, and they've never recovered that index level. And they've had growth of barely 1% for average annual growth of barely 1% for 30 years. So the point is that you could argue, I would argue, that Japan's been in a 30-year depression. The United States is entering its second lost decade. 2010 to 2020 was the lost decade. We're now entering a second lost decade. And that gets to the meaning of depression in the economic sense. So economists like to talk about recession, and recession is
because Japan also doesn't describe it as a depression, but recession. If you go there and if you listen to their economists, they always describe it as a recession. And here on this side of the Atlantic, the talk prior to the COVID-19 was also about recession, but not about depression. So what is your case for a new depression? So right. How are you explaining this?
Right. So recession, you're right. They'll talk about recession, but they've banned what I call the D word. They don't want to talk about depressions. Because the reason is recession is numerically defined. It's 2 or more consecutive quarters of declining GDP. There are a few other, bells and whistles around it, but when you have 2 quarters in a row of declining GDP, that's a recession. Clearly, the United States was in a severe recession in the first half of 2020, but we had very strong growth in the third quarter. It wasn't enough to dig us out of the hole, but you could say this has not been officially declared, but I would say the recession was probably over by July of 2020. But a depression is different. It's not quantitative. It's not strictly quantitative. A lot of people assume that, well, if a depression is 2 quarters of declining GDP and a depression is worse, that must mean, 10 quarters of declining GDP, something horrible. It does not mean that. You can have growth in a depression. What depression means is that the growth is below trend. It's below potential. In other words, it's depressed growth. So if your growth potential is 3.5%, which it is or should be in most developed economies, and your actual growth is 1 to 2%, that gap between potential and actual is lost wealth. That's depressed growth, and that's the meaning of a depression. But depression also has psychological aspects. It has implications for investment, for interest rates, etc. We have depressions, and I make the case that we're in a depression now, but economists won't talk about it because they want something numeric that they can plug into an equation. But we are in a depression, and the effects of this will be intergenerational. And that's something that's not widely understood. There was one study, and I talk about it in my book. It was produced by an economist for the Federal Reserve Bank of San Francisco and 2 academic colleagues, I believe, from the University of California. And they looked at a 650-year time series. That's my kind of time series. I often criticize analysts for doing correlations and regressions on a 2-year time series and go, no, that's junk because you haven't gone back far enough to really see cycles and business cycles and a lot of other events. But 650 years, I'll take that. But they went back to the Black Death of around 1350, and they looked at every pandemic since the Black Death in which 100,000 or more people died, and they found 15 such pandemics. Of course, the 2 worst were the Black Death, where about 75 million people died, is the best estimate. And the Spanish flu of 1918, 1919, in which about 100 million people died, according to the best estimates. By the way, COVID-19 is going to be 3rd on the list. We're at almost 2.5 million fatalities The third on the list until very recently was the Asian flu of 1958 with about 2 million dead. And then there was a Russian outbreak in the 1890s, also with about 2 million dead. COVID-19 is now 2.5 million dead approximately, so it's going to be third on the list. Pardon me. Well, what they discovered in looking at these pandemics, and these were economists, not virologists, but they had the data, and they discovered that the recovery time, and let me define recovery. It's not economic growth per se. It's when do things sort of get back to normal? Pardon me. The right answer is they never get back to normal. I mean, we will survive. We'll get through it. We'll return to our routines, but it will never be the way it was before the pandemic. We will never get back to the world of 2019. We'll be living in a new world, and that's what the evidence shows. But what these economists showed is that in terms of interest rates, employment levels, growth levels, and other important metrics, you don't, pardon me, you don't get back to anything like normal for 30 years. Mm-hmm. Not 30 weeks, not 30 months, but 30 years. And just to give two examples to kind of support what this much more in-depth study shows. In 1929, the U.S. stock market crashed, and that was the beginning of the Great Depression. And it bottomed, pardon me, it took 3 years to bottom. It bottomed in June 1932, down 89.2%, almost 90%. That's what a real stock market crash looks like. But then the question is, well, when did it regain the 1929 high? When did it get back to the old high? The answer is 1954. It took 25 years to get back to that level. Now, it doesn't mean that you couldn't make money in the meantime. If you bought the low in 1932, it went up after that, but it did not get back to the 1929 level until 1954. 25 years later, a lot of people were dead. They didn't live that long. I grew up in the 1950s and early 1960s. I did not live through the Great Depression, but my parents did, and my grandparents did. And I was raised with a kind of a depression mentality. Now, the 50s and 60s were a very prosperous time in U.S. economic history, but we still, as a little kid, we would take the rubber band off the newspaper on the lawn in the morning and put it in a jar to save the rubber bands, because why would you throw away a perfectly good rubber band? And my brothers and I would go out in the neighborhood with wagons, and we'd go door to door, and we'd collect tin cans and newspapers. And we weren't doing it for environmental reasons. Maybe it was good for the environment. We were doing it to recycle the tin, because you could build ships or planes, et cetera. So, and that did not change until the late 1960s, when the baby boom came of age. And then we got, credit cards and mortgages and home equity loans and started spending and consuming like crazy. It did change, but it took 30 years. That the 1930s mentality was still with us in the 1950s and the 1960s. And that's the point, that this pandemic is so bad, it's not something where things are going to get back to normal in a year or two. This will take decades. A 5-year-old girl going to school, her mommy says, honey, put on your coat, put on your hat, and put on your mask. And kids are adaptable. They'll put on the mask and go to school. But that's the kind of experience that stays with you your whole life. Mm-hmm. So monetary policy will not work because of velocity. That's the turnover of money. Fiscal policy will not work because we're past the 90% debt to GDP ratio. We're well past it. We're up around 130% in the case of the United States. So they will print money. They will spend money. We will get higher deficits, but we will not get sustainable growth. I'm not saying we'll have, a permanent recession, but we'll have growth of, maybe once you get past base effects, maybe 1 to 2%, and an increasing debt to GDP ratio, which is more of a headwind of growth. So these policies will not work. We can hand out checks and people will spend them to some extent, but actually savings rates are going up quite a bit. So some of it's being used for consumption, but not anywhere near all of it. U.S. savings rates have doubled. Well, they tripled last spring, and even the new level, they've doubled from where they were for on average 10 years prior to that. So we're seeing increased savings. If you're unemployed, of course you're going to save. You're not going to take your friends out to dinner. But the point is, even if you have your job, maybe your spouse is unemployed or your neighbor's unemployed, or you're worried that you're going to get fired next week or your business is going to close next week. And so people save even if they have a job. That's what economists call precautionary savings, or plain English, saving for a rainy day. But the point is, between Um, uh, those who are unemployed and people who are worried about it, savings have skyrocketed. So even the money that gets handed out doesn't convert to consumption dollar for dollar. Some money does get converted to consumption, but it's not sustainable. It's a one-shot deal. What are you going to do? Do it again and again and again? That can't be the case. So we're in for a very difficult time.
Mm-hmm. And now I would like to go to the geopolitical level.
Okay.
Yes. How do you think the new Great Depression and the whole outlook, the economic and financial outlook that you've outlined for us, is going to affect the relations between the United States and China? What will be the new element in the U.S. politics towards Beijing? My call is that Biden's administration will be actually looking for normalization of relations with Beijing in order to focus more on the economic recovery at home. As you've also outlined it already, spending more at home, making sure that this extremely negative effects are somehow tackled. However, the systemic decoupling will be further ongoing. That means it's not because I think also there was this wrong idea that it was only on the side of Trump and only taking place only on the side of Trump. But in fact, China is also interested in a sort of decoupling. So how do you think that this is going to affect also Chinese policies? What will be the role of the monetary issues? What will be the role of the US dollar in all of this, given that the quantitative easing will be ongoing, so there will be more trillions of US dollars, but also euros. So this whole euro-dollar system is going to be held in order to keep the system afloat, right? To prevent the system from from collapsing. But on the other side, China is also going to introduce measures to somehow decouple and become more independent from the US-led monetary and financial system, be it with digitalization of the yuan, be it through increased presence and participation in international and regional organizations. We saw what they did with World Health Organization during the COVID-19 outbreak, and we are seeing how they are now actively shaping international, agenda, being present at the World Economic Forum, giving speeches here and there. So, what is your take on that? What is your geopolitical outlook based on all these assessments for the economic, financial, and monetary systems?
Right. Well, I have to approach the topic with humility, Velina. You're the number one China expert out there, or one of them. So I usually follow your work, but I do look at it very closely, and I would make the following point: the Biden administration is moving quickly to undo or reverse practically everything the Trump administration did. So if it has Trump's name on it, the Biden administration doesn't like it, and they're undoing it. And they're doing it with executive orders for now, but there'll soon be legislation coming on behind it. However, that is mostly in the realm of domestic policy or nearby foreign policy. I mean, Canada and Mexico. So they're doing things in immigration, gun control, Medicare, obviously domestic spending, the bills we talked about. They're trying to undo, the wall, et cetera. They're trying to undo every policy they can find. They are moving more slowly in international relations. I'm not saying there won't be changes. I expect there will be, but they're not doing them right away. The Democrats have their own problems with the Chinese. They may be different issues than the United States. Trump was fighting a trade war with China, and we had tariffs going back and forth. I think the Biden administration is much less concerned about tariffs, but they haven't reversed any. I mean, we've seen no executive orders and no action by Biden to reduce or eliminate the tariffs on Chinese goods. Now, again, they may get there eventually, but they seem to be going very slowly with regard to China, because the theft of intellectual property is a big deal. Global supply chains have been disrupted. You do need to look more at domestic capacity. I don't think the United States learned the hard way that we're completely vulnerable to the Chinese supply chain when it comes to medicines. There's everyone's saying, where are the masks? Where's the personal protective gear? Where are these treatments? And the answer was they were all coming from China, and that was kind of a shock, I think, to a lot of politicians and a lot of Americans. So we'll be trying to kind of rebuild domestic capacity, and Biden hasn't said a lot about that, but that's clearly the case. Having said that, now China, for its part, is much more aggressive, much more confrontational. I'm sure you know they have the Wolf Warrior diplomacy. Wolf Warrior was a very popular television series in China about some action figure or whatever, but they've taken that term Wolf Warrior and applied it to a new class of diplomat who is much more aggressive, much more confrontational, the usual Chinese style. Deng Xiaoping said, hide your intention, just pursue your goals and hide your intentions, or that's not an exact quote, but that was sort of his model. And they did that for 30 years. Now they're not hiding their intentions anymore. They're confronting India in the Himalayas. They're confronting Taiwan in the Taiwan Strait. They're confronting the United States and the Philippines in the South China Sea, and elsewhere, and moving very aggressively internally with Xinjiang province, and some horrible things going on there that are tantamount to genocide, and they don't seem to care about world opinion. So on the one hand, China's more aggressive. On the other hand, the Biden administration is taking a go slow approach. But there are forces at work that are much bigger than anything we just discussed. So if you have some expectation, I would say the Biden administration will try to undo some of the damage that Trump did. They'll try to, sort of make amends and be friends, but not necessarily upset everything. If you said where in international relations will Biden make more radical changes, I would say Iran. They want to restart the Iran nuclear negotiations, rejoin the Joint Comprehensive Plan of Action. Iran is on a path to have a nuclear weapon. Biden seems to be very anti-Israel. Susan Rice, certainly, she's a domestic policy advisor, but she's anti-Israel. So I would look at the Middle East and U.S. relations with Iran as an example where there will be big changes from what Trump is doing. However, as you know, there's a strong connection between Iran and China. China doesn't have any energy, or they have coal, but the coal has its own problems, and there are limits there, and they import coal from Australia. But they want as much oil as they can, and they get it mainly from Iran, to some extent from Saudi Arabia. So you might see a kind of a triangular trade where the U.S. eases sanctions on Iranian exports of oil to China in exchange for some Iranian cooperation on the nuclear portfolio. But the Iranians are pretty cagey themselves. They'll probably get the better of the deal. I don't think the Biden administration is nearly as adept or forward-leaning as the Trump administration when it comes to dealing with Iran. Having said all of that, there are bigger forces at play, and they tend to be debt-related and demographic. Sorry, I just had a little. China is at an inflection point. China's growth is going to slow. China's productivity is going to decline. And it's because of demographics. They have one of the most rapidly aging societies in the world, not as bad as Japan, but not too far away. And the one-child policy, think about what that means. So you have 4 grandparents, so, 2 couples, and they each have 1 child each. And then those 2 children marry, and they have 1 child. So at a certain point in time, you have 1 grandchild supporting 4 grandparents. That's not sustainable. It's supposed to be the opposite. You're supposed to have a lot of children, a lot of grandchildren, and you have a whole family network to support you in your old age. China, because the one-child policy, which began in 1980, is going to end up upside down. They're going to have 1 grandchild per 4 grandparents at a time when life expectancy is increasing, dependency is increasing, dementia and other debilitating diseases are increasing. And yet you have a smaller population, a shrinking population, entering the working force. So if you think of people in the workforce as being productive, they produce more than they consume. And if you think of much older people as being the opposite, they consume more than they produce, China's growth is going to shrink. Its debt burden is going to be unsustainable. And it's going to move more to a consumption society, less of an export-driven society. These are major changes for Chinese growth and world growth. And I'm not sure if Xi Jinping appreciates it or not. I guess there's somebody in China who does. But they seem to be on a path where, on the one hand, they're more aggressive, wolf-warrior diplomacy, willing to confront all their neighbors, Japan, Taiwan, the United States, etc. And at the same time, their growth is going to slow, their exports are going to slow, their surpluses are going to shrink, and they're going to have a serious demographic confrontation that will greatly reduce their productivity. So I have a very bearish case on the Chinese economy, and this is going to play out. What I'm talking about is going to play out over 10 or 20 years. But I already said that the after effects of the pandemic will play out over 30 years. So I see a world where China's growth is slowing. They're much less productive, much less innovative, and have serious debt problems, but at the same time trying to pursue an aggressive foreign policy. So that's very likely to fail.
Now, I'm seeing that we are approaching the 60 minutes limit, and I also know that you are, you don't have much more time. So I will try to address some questions from the chat room. I will wrap them up, and I will only ask you to, answer very shortly so that we can address all of them. So these are questions more or less related to the global monetary system, as you might guess. And one of them is linked to your expectations about deflation. So are we heading for deflation before stagflation, or inevitably inflation? So what is your take? Please, really very shortly. Then there is a question on the CDR role. What is your adjusted assessment about the role of the CDR system being pushed by the IMF? Also, what is your expectation about, or what is your assessment for gold in 2021, and maybe in a little bit middle term scenario? Given that cryptos have been now witnessing quite of a rise, it's a second, so to say, second moment for crypto, such as Bitcoin, as the one that we observed a few years ago with the skyrocketing price of, I think, around $20,000 per Bitcoin in December. I think it was in 2017, if I'm not wrong, or 2018. And now Bitcoin has been skyrocketing. So what is your assessment on that? So this is my wrap up, I think, for to keep it as short as possible for you.
Good. I'll try to be brief, but we got deflation, SDRs, gold, and crypto. My expectation is deflation in the short run, inflation in the long run. Everything I just talked about with China with regard to aging societies, lower productivity, what's called the dependency ratio, where there are more dependents relative to working age population. That's true in China, but it's more true in Japan, and it's equally true in Europe and the United States. Spain, for example, has the most rapidly aging population in Europe. So these factors are all true. So I expect deflation for now because of economic shutdowns, high unemployment, recovery from the depression. The continuation of the depression, recovery from what just happened with the pandemic. So deflation now, but in the longer run, meaning beginning in 2022 and certainly beyond that, you will have much higher inflation. As far as SDRs are concerned, they're back. They were last issued in 2009 and a little bit in 2011. It was a technical adjustment. But now the G7 wants a $500 billion equivalent issue of SDRs. but there's some talk of as much as 2 trillion. So think of it's the world money. They don't call it that. They call it the special drawing right, but it's world money. And the IMF has a printing press, the same as the ECB or the Fed. So they're cranking up the printing press. So we're going to see more and more world money, which would lead to a growth in SDR assets, maybe an SDR bond market. This will take years to play out. It's not an overnight thing. That's certainly a move in the direction of world money, but it's also tends to be inflationary. You print money out of thin air, you'll get some inflation. Gold, extremely bullish on gold. I expect gold to go to between $10,000 and $15,000 an ounce by 2025, if not sooner. So, and I always say gold doesn't change. When gold goes to $15,000 an ounce, it's not about gold, it's about the dollar. What you're looking at is an extreme devaluation of the dollar, and that's consistent with the inflation thesis that I talked about a minute ago. Crypto, I think here you have to say who's crypto. There are over 2,000 so-called cryptocurrencies. So I look at Bitcoin and Ether and Ripple as, it's a form of gambling. I prefer roulette. You can have a nice drink and enjoy the ambiance in the casino, but they're not really good for anything. They won't be reserve currencies because there's no bond market. People think that currencies are what make you a reserve currency, but that's not true. It's the bond market. When you say the People's Bank of China has $1.4 trillion, well, they don't have dollars stacked up on pallets in the basement of the People's Bank of China. They have U.S. Treasury securities, $1.4 trillion of U.S. Treasury securities. So they have dollar-denominated assets, but it's the assets that make you a reserve currency, a deep liquid bond market with primary dealers, auctions, payment systems, when-issued trading, futures, options, hedging techniques, rule of law. You need a whole infrastructure that the U.S. has developed over 230 years to support reserve currency status. Bitcoin has none of that, and nor will it, because it's inherently deflationary. Who wants to borrow money in a deflationary currency? The answer is nobody. So there's speculations. It's like gambling. If you enjoy it, that's fine, but I don't see them having a role in the international monetary system. But if you're talking about central bank digital currencies, the CBDCs, that's different. China is very far along. Europe is seriously considering it. The U.S. hasn't moved that quickly, but they're looking at it also. But I would say the most successful cryptocurrency in the world is the U.S. dollar, because the last time the last time the Treasury issued a paper Treasury note was 1980. It's been 100% digital ledger ever since. It's not blockchain, but it's a digital ledger with encrypted message traffic. So what's the difference? The Fed may move to blockchain as a ledger, but it's still a dollar, it's still a euro, it's still a Japanese yen if it's in digital form. That has more to do with how you maintain the ledger, and it does have a lot to do with getting rid of cash. And that's a completely different issue. The developed economies have wanted to get rid of cash for a long time so they can impose negative interest rates, engage in surveillance state techniques. If I spend cash, you don't know I did it. But if everything's 100% digital, your credit card and your debit card and your iPhone payment, waiving or whatever it is, gives governments perfect information about your whereabouts and your spending habits at all times. So I view central bank digital currencies as a surveillance tool and a way to eliminate cash, quite different from private digital currencies, which are really kind of just gambling venues.
Mm-hmm. And also, given that there will be a launch of central banks digital currencies, just like China already did, and the ECB President Lagarde also announced readiness on the side of the Europeans to launch a digital euro. I think that it's just a matter of time to witness state regulations for private crypto, so to say. So
I agree. The central banks will not let the private cryptos get that far.
Mm-hmm. Do you still see gold becoming reserve currency, given that China and Russia continued stockpiling actually gold, or is it just the hedge? Next to being money, a kind of a hedge for investors?
Yeah, it's look, gold is a reserve. It's a monetary reserve. It's a form of money. You're right about Russia and China. Russia's an interesting case. I always say Velina Tchakarova is my favorite investment banker. She said, or sorry, my favorite central banker. She seems to be the only one who knows what she's doing. But Russia got their gold reserves to 20% of total reserves. They got their gold. Gold is about 20% of Russian reserves, and then they stopped. They haven't bought any gold for about 6 months after 10 years of buying. Well, why did they do that? Well, two reasons. One, 20% was my estimate is 20% was their target. China's about 2%. So 20% is a very large percentage of total reserves to have in a single asset. But that percentage can go up without buying any more gold. All you have to do is wait for the price to go up. In other words, if dollars, in nominal dollars, if you have euros or dollars, and they don't change, and they have very low interest rates, and they don't change, but the dollar price of gold goes up, gold as a percentage of reserves will increase without buying any more gold simply because of the price action. So she really knows what she's doing. But I think they'll sit tight for the time being and just let the price of gold take care of itself, which is a hedge against inflation. And we already said that we're in for deflation in the short run, but probably almost certainly inflation in the intermediate to long run. So Russia is exactly where they want to be. So you don't have to predict a gold standard. We could have a gold standard, but I don't necessarily see that. I think very few central bankers either understand it. They certainly don't want it. But that doesn't alter the fact that gold is a major monetary asset and is now a significant portion of the global reserves of a lot of developed economies, including Germany, Italy. I love Mario Draghi. He's now, I guess, the new prime minister of Italy, and before that, head of the ECB. But he was doing a Q&A at Harvard about 5 years ago, and people forget that he used to be the finance minister of Italy.
Mm-hmm. Whatever it takes.
Yeah, that's right. And someone asked him about gold, and he said, I never sold an ounce of gold when I was finance minister of Italy, not 1 ounce, because I considered it a hedge against the declining dollar. So that tells you where he's coming from.
Yes, by the way, when we talk about the European powers and the European states, even middle sized states, there has been a clear trend in the last years of repatriation of their gold.
Yes, gold's coming home.
Yeah, gold is coming home. And I have to address another question because I think it's interesting for the audience. Very short answer on your side, please. There is a message, for instance, regarding India, that India has been also mulling on the CBDC. And the question is, if gold is going down versus Bitcoin climbing up, is there, in your view, correlation? Are they linked, just like let's take the US dollar and the euro correlation? And then there is a question about whether one should invest in physical gold or rather in gold miners such as Barrick.
Well, there's no important correlation between gold and Bitcoin. I mean, if the total market capitalization of Bitcoin is trivial compared to the market capitalization of gold. So it's not, even if Bitcoin went up more and more people bought Bitcoin, there's not enough capital in Bitcoin. And by the way, a lot of that market capitalization is just price increases. It doesn't mean that $1 trillion went into Bitcoin. It just means that whatever amount is in Bitcoin is now worth $1 trillion according to Bitcoin exchanges. It doesn't mean they actually have $1 trillion. $1 trillion went into it. But the point is that number is still trivial relative to the size of gold. So it's not an important correlation. I know that story's been out there. India, of course, wants digital currencies because they hate paper currency as it is. They were the ones who tore up, I forget what rupee denomination, it was 1,000 rupees or some note, about 4 or 5 years ago. They just canceled the notes and said, you got to bring them in and get different currencies. So India hates paper money, and I'm not surprised that they want to see a digital currency for the same reason other countries do, which is surveillance and possible negative interest rates, confiscation, account freezes, basically control of the population. When you say Bitcoin's going up, gold's going down, I don't think Bitcoin's very important. Gold is fluctuating. I was down yesterday or a couple of days ago, but again, it's doubled in the last 5 years, and the long-term trend is much higher.
Mhm. Okay, I suggest that we make an end at that point. We haven't addressed the chapter 5, which is, dealing with the more or less social repercussions of the COVID-19 crisis, but we will probably need another hour just to, discuss all the issues related to society, to the devastating effects of the pandemic, the loss of trust, and the all other linked phenomena that we are observing right now in the West. And more importantly, we haven't addressed chapter 6, which is actually dealing with investing advices
Right.
in a post-pandemic world. But let's keep the suspense, because the audience should buy the book if
Yep.
they are interested in finding out what would be logical solutions for a post-pandemic world, what could be valuable strategies for investors. Find out by buying the book. And Jim, I really want to thank you for staying with me for more than 70 minutes and once again addressing all these issues. I suppose that we have to do another digital talk in less than a year to discuss where we are, right?
Sure. Perfect.
You've been correct with so many calls last time. And I suppose, let's say, I'm afraid that this time you will be certainly correct once again by pointing to the long-lasting economic degrowth, so to say, or depressed growth that developed economies in the West are going to deal with. So thank you very much.
Thank you, Velina. Great to be with you.
See you next time.
Bye-bye.
Bye-bye.